Good morning and welcome to the Traction Financial Partners 2025 Q1 market and economic recap. We are happy to have you join us here today, April 17th, 2025. Obviously, a interesting time in the markets and in the economy. We're excited to share with you our thoughts as we go through the webinar today. If you have questions throughout, we'll get to those at the end, but make sure that you type those into the Q&A as part of the webinar here. So again, if you want to ask a question, please put it in the Q&A and we'll get to those at the end. Hopefully we have plenty of time to answer as many questions as possible, but we'll get going. Okay, today's agenda, tariff overview. We're going to get right into it. I've graciously asked Drew to go through the tariff overview. We want to make sure that we cover that topic first and foremost. That's what's in the news. That's what's driving a lot of the volatility in the markets. And so we want to make sure we get that covered from all sides. We're going to make sure we talk about it, just what the facts are, what the administration is saying, what some of the opposition could be to those. We want to make sure we share all the information as possible and then add some context to it. And then we'll get into the 2025 year-to-date equity market overview, same thing with the fixed income side of things. And then we will finish with markets in perspective. I think there's some really fascinating data that we'd like to cover with you. But let's go ahead and jump in. I'm going to have Drew lead us off here with the tariff overview.
All right, thank you very much, Evan. So obviously the talk of the media, particularly the financial and economic media, is the rollout of the tariffs from the Trump administration. And so there was a lot of buildup to the rollout. No one quite knew what to expect, and it's a very fluid situation. So I think that's one thing that we need to keep in mind as we discuss this today, is that the current landscape in which we're dealing with, which we'll talk to, is very likely to change as we go on, as we move forward here. So first and foremost, we just kind of want to speak to, what are tariffs exactly? That hasn't really been a big topic in the U.S. economy for a while, and are they good or are they bad? So ultimately, tariffs are taxes or duties that are imposed on imported goods. So a cargo ship from with a bunch of goods from some foreign country comes into a port, that gets offloaded into the port, and it is stamped with a tariff duty, and that tariff is paid and then collected by the government. So ultimately, it's a pretty highly debated and highly contentious topic in terms of are they good? Are they bad? Do they make sense? Are they going to be detrimental? And what we want to talk through today is just kind of both sides of the argument. What does the current administration say? What is their reasoning and their advocacy for this policy? And then what do the opponents of this particular policy have to say as well? What are the drawbacks and disadvantages to tariffs? So in the table that we have here, we've got on the left-hand side, we've got kind of the administration's reasoning and why they say there's benefits to it. On the right, we have drawbacks and disadvantages. So there's kind of three main reasons, I would say, as to why the administration is advocating for their use of tariffs. The first one is it's an additional source of tax revenue. Now, how much that will bring in tax revenue, of course, remains to be seen. We've already seen the initial rollout of what was called reciprocal tariffs. That was a relatively misleading label of what they were, because the tariffs were not reciprocal. Just, if country A charges this tariff, the US is now charging that same tariff. It was really more a rollout of here's kind of the trade imbalance between our two countries, and we're going to tariff as a result of what that trade imbalance is. So we saw the initial rollout, and various countries had various levels of tariffs imposed on them. With the exception of China, we've now seen that come back to a minimum 10% on all countries, paused for 90 days. And we're only a week or so into that. And so right now, every country that's importing or exporting into the US has a 10% tariff, except for China. We've been seeing a lot of tit for tat on that. And so China's much higher. So where that ultimately lands, we don't know, but it is an additional source of tax revenue. Another main reason is to encourage and protect domestic jobs and manufacturing to, kind of what they say is to reshore manufacturing in the US. Again, we'll see how that unfolds. I think one thing to keep in mind is if they are successful in that, that will still take time to materialize. It takes time to build plants. It takes time to hire and make them operational. So even if that's a success, that certainly will take time. Now, another big topic is being used as a tool for trade negotiations. And not just in trade negotiations. We've seen, according to the administration, 130 countries reach out to start bilateral trade negotiations and hopefully renegotiate trade deal, call it better, so to speak, trade deals for the US. So that's brought allegedly 130 countries to the table for negotiations at this time. It's also kind of used as a tool like for Mexico, for example, to have them help secure the border. So it's used as a negotiation tactic in other areas too, not just from a trade perspective, but it's used as a tool for negotiations. The administration will tell you it's to address perceived unfair trade practices. So there's tariffs, there's non-tariff barriers, meaning like they put restrictions on what we can export into those countries. An example is you don't see an awful lot of Chevys being driven around in Japan or a lot of GMCs being driven around in the EU. So there are barriers that are put in place. And so tariffs are, per the administration, a response to try to hopefully bring down some of those other barriers. Currency manipulation is a big one that they'll certainly accuse China of. So those are some of the, unfair trade practices beyond just tariffs. And then last, it's to reindustrialize sectors deemed critical to national security. So being less reliant on potentially adversarial countries in sectors like energy, technology, pharma, and materials, steel, aluminum, things like that. And I think we saw some issues there when COVID came about. I think it was pretty clear that, some of these items might be best if we could make some of them here as well. Okay, so that's why the administration is advocating for their current tariff policy. Now, you've certainly got no shortage of people that are opposed to the tariff policy, and here's some of the reasons why from their perspective. As we've pretty evidently seen in the last couple of weeks in the market, it creates a good deal of uncertainty, and that leads to volatility. The market likes certainty to the best degree that it can. And right now, there's an awful lot of uncertainty with what are tariffs going to be, what is retaliation from other countries going to be, and then that also puts uncertainty on businesses. They may not be able to move forward with certain plans until they kind of have some clarity on like, okay, where are these things going to ultimately end up? I think the big one that you will hear a lot about in the media as well is inflation, a potential increase in the cost of goods to consumers if companies are passing that on. So if you're a company that imports your goods and you're now being charged a tariff on those goods, well, are you going to eat all of that cost yourself? Or are you going to have the folks that you're importing it from try to eat the cost, or are you going to pass all of that on to the consumer? Now, I think one important thing to keep in mind here is supply and demand dynamics remain in place. So, will certain costs very likely go up? I think that's probably pretty likely in certain regards. But if you get a 100% tariff or a 40% tariff, can you realistically just pass all of that cost on to the consumer? Well, likely not, because the consumer can't, just from a demand perspective, may not be able to meet that higher burden. So it's probably not a one for one there, but it certainly is likely that some costs go up as a result. And we're mostly seeing the third bullet there on the right. We're mostly seeing this with China right now. Trade wars and retaliation, which just further adds to the uncertainty and security. So, the initial tariff with China started in the 34, 37%, somewhere in there. They retaliated, we raised it, then they raised it, and it's just kind of this battle of going back and forth. And now I think it's 145 to 245% tariffs on China. So, and they're retaliating with tariffs of their own. They're retaliating in other areas as well that are not just trade-based or not just goods-based, but also services-based. So that leads to a lot of uncertainty, and you just don't know where that escalation may lead to. Of course, it could potentially depress economic growth, particularly in a economy that's consumption-based like the USA, right? We generally are importing the bulk of the goods that we utilize in this country. And if there's strain on those supply chains, if there's higher elevated costs, that can have a negative economic impact. And if the second to the last bullet there, competition with companies. Companies could just decide to leave certain markets because it may just not make sense for them anymore. And then I mentioned a moment ago, but a disruption of current supply chains. So that's kind of the both sides of the argument. We're not here to take a side in that argument. We just want to present what the rationale is on either side. I think it's also important to keep in mind that while the tariff discussion is kind of driving the media attention, it is also, one component of the administration's current economic strategy. We'll see how it works with the other components like deregulation, tax legislation, higher energy production, things like that. So that's kind of where things stand. And I think the one certainty we have in all of this uncertainty is that it's going to keep changing, and that we're going to negotiate deals with countries. Some countries are going to retaliate. We'll see where it ends up, but that's kind of the lay of the land on where things stand today. Okay, so with this new major policy shift, it's really important to revisit history. Now, obviously, the US economy and the global economy are different today in 2025 than they were, 20, 50, 100, 200 years ago. But we want to look back into history to see if this is, see how we've handled periods like this in the past. So as you can see right now, on the far right-hand side of the screen, the average tariff rate, and this has gone up a little bit since the first Trump administration, but we're around 2-3%. We can see that it's been quite low for really the last, call it 50 years, and not even too meaningfully high beyond that. So the last time we saw tariffs of around 25% was prior to World War II. Now, as a result of World War II and the destruction that we saw, particularly in Europe, we really lowered our tariffs as a result of that to allow, our allies in Europe to kind of rebuild their economies. And since then, tariffs have remained pretty low for the US. But I mean, if you keep going back even further and further, and again, I know you can't compare 2025 to 1830, but we've seen tariffs of 57%. 47%. Coming into the early 1900s, tariffs practically funded our entire government, and income taxes weren't really in place. So we have seen this historically. Again, it's hard to draw perfect parallels because the dynamics are so different today versus then. But there is some precedent to what we're seeing. And I think the current estimates on where things are today, and again, that's a moving target, is the effective US tariff rate on all countries blended together is probably a little north of like 20% right now. So right around there. So, call it maybe up towards this 20% line. So we'll see where it all shakes out, but that's just some historical context. Now, the bulk of our trade comes from our top 10 trading partners. And here's where tariffs currently are for these various countries. So you can see currently we have the lowest tariff rate of around 3%. Then we've got all of our other countries here, Japan, Canada, the EU. The bulk of our trade is done with the EU, Mexico, Canada, and China. Those four areas are the vast, vast majority of all of our trade. And you can see they do certainly impose higher tariffs than we have and have historically in recent memory. But again, we would be the biggest bar on this list if we go based off of where the current administration tariff policy is. So we'll see how negotiations go and where that number ends up. But just to bring some additional historical context compared to our top trading partners, we've always historically had the lowest tariff rate. Okay, so something you've seen the administration do, I talked about how for that 90-day pause, there's a 10% minimum tariff on all countries. There is, except for China. But there's also a couple of things that I talked about on that first slide that this administration kind of deems critical to national security, that they're imposing specific tariffs on from an industry perspective. So there are 25% tariffs, regardless of where it's coming from, on steel, aluminum, and foreign autos, so foreign cars. And so I think that speaks to the top 5 imported products: motor vehicle parts and cars, computers and phones, so call it tech, and then crude petroleum, so oil. And with our top 3 individual countries as trade partners being Canada, Mexico, and China, you kind of get a sense of where we're getting the bulk of these products from. So computers and phones, you can see China here is this yellow, light orangish color. They're the bulk of our tech components. And then if we look at petroleum, we can see Canada is certainly our biggest, where we import the most from in terms of oil and gas. And then also in terms of cars, you can see Canada and Mexico and the vehicle parts make up the bulk of that. So when you see that, Canada and Mexico are getting targeted tariffs and China are getting targeted tariffs, it's because they're producing the products that we import the most of, and also the products that this administration deems to be most critical. Okay, so our last slide on tariffs is, again, we like to view history to give us as many cues as we can get. And Trump's first term, he certainly put a lot of tariffs in place, not to the degree that we're currently dealing with, but we think it's important to at least peer into how did things kind of unfold during that period of time. So he took office for his first term in 2017. And by the end of 2017, you can see there's all these various events here. He imposed tariffs on solar panels and washing machines. Steel and aluminum tariffs go into effect. And then we start to have retaliations from China. Then we have certain exemptions like we've seen now. He released, I believe it was late last week, that phones, computers, computer chips, and there might have been one other that I'm missing, are exempt from the higher tariffs, even from China, for a period of time until they ultimately impose different tariffs on that. So this gives us on a smaller scale, a view into what it was like last time. So in blue here, this is the stock market, the S&P 500. So starting at 10,000 here at the end of 2017, pretty much going through the end of 2019. So about a 2-year period. Now, the orange line is year over year change in CPI, Consumer Price Index, or inflation. Now, again, I think the main fear is that tariffs will drive inflation. So, again, these tariffs were not to the degree they are today, but inflation is this orange line. We can see inflation did go up a little bit initially, close to, if we're looking over here on our right-hand side, close to about 3%. And then over time, that trended down pretty low, kind of below 1.5% or around that area before kind of coming back to about 2.5% by the end of that period. And the market did what it always does in the short run. It goes up, it goes down, it goes up, it goes down. But despite all of these new policies and retaliations, we did see 10,000 end up being north of 12,000 or over a 20% gain in the market over that 2-year period. So we don't know how things will play out this time. We don't know what the impact on inflation is. Tariffs are not the only thing driving inflation. There's energy production, oil and oil prices and gas prices are the main driver of inflation. They go into everything. They go to in the plants that create the products. They you have to ship those products to wherever they're going, whether it's plane, train, or automobile or truck. So there's gas there. So there's a lot more to inflation than just tariffs. But despite the tariffs that went in place during Trump's first term, inflation remained pretty subdued, and we did see gains in the market. So we'll see how things unfold. We just wanted to kind of lay out a brief history of tariff policy. And again, I think the one thing we can count on today is that we're going to keep seeing changes. It's a dynamic situation. But with that, we've seen a lot of volatility and a lot of uncertainty. And I'll turn it back over to Evan so he can speak to some of what we're seeing in the equity markets.
Thank you, Drew. Drew, the short straw, and had to talk about the tariffs, but he did a fantastic job. And I think that added a lot of context to what we're currently seeing. And like as he said, the only certainty is kind of the uncertainty until we kind of figure out how things unfold. But let's talk about the stock market. So far this year, which has been quite volatile. This is the stock index performance for most of the major indexes that we track through the end of last week. So this was through April 11th. Okay, we're going to focus primarily on the year-to-date column. Okay, year-to-date through the end of last week, the Dow Jones was down around 5%. Okay, I believe that's dropped some this week, but as of last Friday, we are down about 5% on the Dow. The S&P 500 is down about 8.5% year-to-date. Okay. We're going to talk more about the volatility we've seen. Drew's going to finish the webinar with some context and some historical data and perspective around, hey, what happens after large drops like this? And so the S&P primarily is the index that we're going to be talking about when it comes to that type of perspective. The S&P did go into correction territory this year, which is a 10% or more drop, and actually briefly touched bear market, which is a 20% drop. This is year to date. We were actually positive in the stock market on the S&P, I believe, till mid-February was around the peak. But again, currently down around 8.5. I think it's a little bit over 9 at the moment. The NASDAQ. So the NASDAQ 100, which is going to be more of the tech stocks, more growth-oriented type companies, down over 10% year to date. Down, it's more than this at the moment. Tech stocks really led us out of the 2022 bear market, which I'm going to talk more about here in a second. It's hard to remember that. It doesn't seem that long ago, that 3 years ago we actually had a bear market, and we recovered from that, and that recovery was driven a lot by the tech stocks that are included in the Nasdaq 100. Okay, not going to go through each of these, but S&P 500 growth versus value. So I just talked about the tech stocks that would fall into the growth category, down about 10.72%. S&P 500 value. So value stocks would be a lot of the Dow Jones stocks and energy companies, banks, the more dividend-paying type stocks have weathered the storm a little bit better this year, while still being down about 6% on the S&P 500 value. And as we go down the list here, the most volatile and the biggest drop so far, we're going to see in the mid and small size stocks. Okay, you can see the split there between growth and value on the mid cap 400 and the small cap 600, and what we've seen in terms of drops so far this year. When it comes to volatility in the market and uncertainty in the economy, smaller size stocks tend to be more volatile, because if we're going into a slower economic period, they tend to get hit hardest. They also tend to run a little bit leaner when it comes to their margins and their profit. And as interest rates have stayed higher, they borrow a lot more. That also can kind of squeeze their profit margins as well. So smaller and mid-sized stocks have struggled this year for sure. Okay. And as we go out even further down, Russell 2000 is going to be our small cap stocks, down 16%. That's kind of the broad-based small cap index. We do have some positives in here. International stocks. So MSCI EAFE, that's Europe, Australasia, and Far East. So kind of the developed economies across the globe, up 2.41% this year. This speaks to, again, the power of diversification, right? So the fact is that you want some exposure to a lot of these different parts of the global market. We use international stocks in our portfolios. International has done better this year than domestic stocks. The second one from the bottom is going to be the emerging markets. Think of China, India, Brazil, those types of countries. Down about 2.2, again, doing better than domestic stocks, but still down so far this year. And then the very bottom index there is going to be the commodities index. All right. Energy costs coming down is a big factor in the reason that the commodity prices and commodity index has dropped. Okay. We already did the 2024 review in January when we had our webinar, but I'll leave this up here for 10 seconds so you can see the type of returns we had last year, right? So while we're going through a period of volatility now, year to date, that is coming off of a 2024, which had really solid returns, which was also coming off of a 2023 that had solid returns. Okay, so while short-term volatility is not fun, there's reasons behind it, tariffs being a big one right now. But we'll add some context to it here later in the webinar, that over time, being in the market is the most important thing. All right. So U.S. stock leadership reversal. We've gone through the Magnificent Seven multiple times in the webinars, and we're going to continue to do so because they play such a key role in terms of what's going on in the market. So briefly, on the left-hand side, the 2024 returns, you can see individually on Microsoft, Apple, NVIDIA, Amazon, Meta, which is Facebook, Google, and then Tesla. You can see what those individual stocks did in 2024. The S&P 500 itself last year did 25% total return. And let's look at the bottom here. Okay, so the 2024 bottom left contributions to the S&P 500 return. 25% total return. The Magnificent Seven, those seven stocks, when you put them together, and I believe right now they make up around 30% or so of the S&P 500, maybe a little bit more. They added, of the 25% rate of return, 13% or almost 13.5 came from those seven stocks. 493 other stocks made up the other 11.5% rate of return. So last year, more than half of the return came from these seven stocks. Okay, so let's see how they're doing this year. 2025 Q1 returns, upper right-hand corner. So this is through the first quarter, right? So we're a couple weeks out from this, but through the first quarter, Microsoft was down 11, Apple was down 11, Nvidia was down 19, Amazon down 13, Facebook down 1, Google down 18. As you may have heard, there's been some volatility in Tesla this year. Tesla was down 36% in the first quarter. The S&P 500 itself, if we look in the bottom right, S&P 500 in the first quarter, now we're down more than this year to date, but through the end of March, S&P was down 4.3%. Of that return, if you look here, the Magnificent Seven combined was down almost 4.9%. The rest of the stocks were actually positive when you put them together. 493 stocks actually had a positive return in the first quarter. The drop in the first quarter, a lot of people call it the Mag 7 drop. Okay, now the rest of the market's kind of participating in that as we've gotten into April. But the biggest part and the main reason the S&P 500 was down in the first quarter was because of those 7 stocks. That's how big they are. That's how influential they are. And that's, again, it's awesome when they're going up like they did last year. But the reason that diversification matters is because you don't want to be just so concentrated in 7 stocks. All right, our equity style box comparison. All right, so year to date, let's look in the upper part here in the box. And the way this reads is the top line here is going to be large cap stocks. Mid cap is going to be the middle row here, and then small cap at the bottom. And then value up and down on the left side, blend in the middle, growth on the right-hand side. So in the first quarter, the only style that was positive was large cap value. Everything else was negative in the first quarter. And the growth stocks, remember those tech stocks that have turned downwards, the growth had the biggest struggle. All right. And this has been a little bit of the opposite of what we've seen in the last few years because, again, growth was doing better in value. So the rotation has happened to where value stocks are outperforming. But for some context, if we look at the bottom style box, this is since the market low in October of 2022. All right. So refresher again, we had a bear market in 2022. The S&P that year, I believe, finished down 18 or 19%. At one point, we were down 23, 24. All right. The bottom happened in October of 2022. Since that point, even given this year's correction and flirting with bear market, look at the returns that have happened since the bottom of October 2022. All right, large cap growth in the upper right-hand corner is still up 76% through the first quarter of this year. Okay. Even the worst performer since the bottom, small cap value, is up 21% over those 3 years, or call it 2.5 years. All right. So again, volatility is normal. Unfortunately, that's the case. We don't like it. It doesn't feel good. But being in the market over time is the best way to invest. All right. So this is an interesting piece here. What this is showing us is the percentage of S&P 500 members that are outperforming the index. Okay. So, for example, let's look at just focusing on 2023 and 2024. Well, this is saying in 2023, only 27% of the members of the S&P 500 actually did more in terms of performance than the index did that year. Okay. In 2024, 28% of the members did better than the index. So not a big percentage of the stocks actually did better than the index. And that's because so much of the returns were concentrated in just those Magnificent Seven type stocks. So in 2023 and 2024, when the market did really well, actually most of the members inside the S&P 500 didn't do better than the index itself. This year, the number is up to 62%. So again, diversification during volatile times is really going to help you out to where you're not just in the Mag 7, you're diversified across the market. And so 62% of the S&P 500 members are doing better than the index itself this year. Okay. Okay, and so if we're always kind of curious how different parts of the economy, different parts of the market are doing. One thing that we do internally as an investment committee and how we've built our models and our portfolios is we have kind of our core holdings, and then we will build satellite investment opportunities around that. So if we believe that energy is going to do well for the next 6, 9, 12 months, we could invest directly into that sector. That's what we consider a sector allocation, which would be a satellite holding inside the portfolios. And so let's see what different sectors have done this year. Through the first quarter, energy was the best performer. Healthcare was second. Utilities, consumer staples. So think of those four areas: energy, healthcare, utilities, and consumer staples. When we're having uncertainty, people tend to go towards areas that we're always going to need, right? You're always going to need energy, you're always going to need healthcare, always going to use utilities, and consumer staples would be, toilet paper and those types of things, and everybody that's buying toothpaste and whatever it might be. The consumer discretionary stuff is more, hey, if I have discretionary income, then I'm spending it on these products that I may not otherwise, if things are a little bit tighter. So the top four sectors this year, which makes sense when you have the volatility that we've seen, are all sectors that we need. Okay. Real estate, financials, materials, kind of in the middle there. Industrial's pretty flat, and you can see what the S&P itself has done. And the bottom three: communication services, information technology, consumer discretionary. Think of Google, Apple, and Amazon across the board there. Okay, so again, it's been a little bit of a reversal this year from what we've seen the last few years. And again, I'm going to keep pounding this is why diversification is important. All right, that's the stock market and what we've seen so far this year. Now let's look at bonds. And we've focused and honed in on bonds the last few years much more than we typically would, because they're supposed to be boring, supposed to pay us interest, supposed to add a part of our portfolio that takes risk off the table. But as we look at bonds now, we believe bonds are starting to act like bonds and will be a tool that we use for those who aren't 100% in stocks, which almost nobody is. We have some that are, but for the most part, some portion of the portfolio is going to be in bonds, and now bonds are acting as a hedge against risk and could potentially add some nice returns this year. So let's look at the very top, and we're going to focus on that one, the U.S. aggregate. Okay, so that's the broad-based fixed income index that we track. It has treasuries, corporates in there, all investment grade type stuff. And if we look at the year-to-date column, through last Friday, we're up about 1%. Okay, we were up more. Interest rates have popped back up, which have brought the prices of bonds back down, but we're still positive for the year on bonds. I skipped this, jump over to the left where you see yield. Okay, so think of that kind of as basically the interest that you're going to get. The aggregate bond index is paying 4.86%. I'm going to have another slide here in a second that will go into what returns we can expect if interest rates stayed flat, went up, or went down. But that by itself is much more appealing and attractive than it had been in years past. So yielding 4.68 or 86%, excuse me. This quarter so far, you can see that we're down 1.68 on bonds. So interest rates going up have hurt bond prices. But look at the last year. So 1 year means just year over year, mid-April to mid-April. Bonds have returned 5.25%. Okay. And those are a type of returns that we are hoping for and expecting bonds can deliver for us, is something like that, where we get a more normalized interest rate market. We have some concerns around how much interest rates can drop given our debt and deficit and those types of things. But the fact is that bonds are more attractive than they've been in a while. All right. And here's the reason that bonds have done so well over the last year is if we look at the key interest rates, let's focus primarily on the second one. Okay. So the 10-year US Treasury is where the market tends to focus on. So a year ago, the second column from the right, we were at what, 4.56%. Okay. Now we're at 4.48. Interest rates haven't come down a lot, but they've come down a little. And then basically remaining flat means your return is going to be whatever the yield is, right? So that's why we're seeing a nice 1-year return. And you can see on the interest rate front here, from the beginning of the year, we're down a little bit. The 10-year Treasury was at 4.58 to start the year. We're at 4.48 now. Rates have been popping around a little bit based on inflation expectations, spending, all that type of stuff. Something that we have seen this year is, look at the second one from the bottom, 30-year fixed mortgage. Something we watch very closely is the real estate market as well. Currently, 30-year fixed mortgages are back below 7. Coming into the year, we were a little bit over 7%, but now that's dropped. Real estate's definitely slowed down. We've seen prices coming down. There was got to be some type of a give and take there, depending on the market you're in, right? Supply and demand issues. But overall, when you're over 7% on mortgages, that's going to slow down the real estate market some until prices do drop. All right, so there's a lot going on this slide here. I'm going to focus on right here in the middle, the US aggregate. Okay, it's similar in the index we were just talking about. Okay, I want to focus on what returns will look like on bonds, that aggregate bond index, if we see a change in interest rates, whether it falls 1%, no change in interest rates, or if it rises 1%. Okay, so US aggregate bond index, there's all these different types of bonds in here, but this is the one I wanted to focus on to make it a little bit clearer. Is that if interest rates fall 1%, the return, the 1-year total return on the aggregate bond index would be 10.7. Okay, we don't anticipate rates dropping by 1%, but if they did, we could see a double-digit return on bonds because you're getting your 4.5% yield, plus the prices would go up if interest rates fell. All right. If rates stayed flat, didn't change at all, then you just get your yield, and in this case, it's 4.6% rate of return. All right, and then if rates went up a full 1%, you could see a negative return on bonds, but it's a lot more muted than it used to be. So now a 1.5% drop in bonds is kind of the worst case scenario if we saw a rise of 1%. If it went up more than that, you can see a bigger drop. We think that we're pretty range bound now on interest rates. We can see rates popping around here, but not significant changes, in our opinion, most likely throughout the rest of the year. All right, I believe this is the last thing for bonds. Wanted to show you again how bonds are supposed to be there to take some risk off the table. They shouldn't correlate directly with the stock market. Okay, there should be some type of low correlation where the market's flying around maybe, and bonds should be more stability. Okay, 2022, and this is something that's important that we wanted to focus on. If you look back here at 2022, on the right-hand side, the max drawdown on bonds, the biggest drop, we had a 17% drop on bonds. Look in the box in the bottom corner here, left-hand side, total returns 2022. We finished the year down 13 in bonds. Stocks finished down 19. Okay, that is the anomaly. That's why we believe currently, I mean, we're only a little bit more of a quarter into this year. 2022 was a much worse scenario than we are currently in terms of bonds having a tough time and stocks. This year, stocks are volatile, but at least bonds are there to add a little bit of stability to the portfolio. Depending on your risk tolerance, it's going to depend on how much you have in the portfolio. But in 2008, you can see in the total returns here, S&P finished down 37%. Bonds were positive that year at 5. Okay, That's how it should work. 2022, because interest rates were so low to begin with, and then inflation was so hot that the Fed started increasing interest rates that hurt both stocks and bonds. We believe we're much more aligned with a normal type of return or comparison scenario between stocks and bonds. And so that's why diversification from a risk perspective is also as important as ever, is to understand that relationship. All right, I'm going to pass it over to Drew to finish us off here with some market perspectives, and then we'll see if we have any questions.
All right, thank you very much, Evan. So before we dive into market perspectives, just some additional commentary on what Evan just went through and showed you. The volatility has been high. It's maybe felt pretty vicious. It's based off of a whole new economic strategy and policy set that we're not used to. But despite all of that, we have a market that is still positive over the last 12 months. And even year to date, with the market down, we have diversified portfolios where bonds and international stocks are both positive. So I'm here to suggest it probably feels worse than it really is. And so again, that's why we just want to help put things in perspective. Now, we're very pleased with all of our clients. I don't believe we've gotten one call during all the volatility that we've seen asking us to sell out of the market. We've maybe answered a handful of questions and helped reassure some clients, but to my knowledge, we haven't had one client that sold out of the market. And here's why that's so important, because you never know in the midst of the volatility goes both ways. We think about it as declines, but in the middle of that volatility, you see some pretty sharp bounce back days as well. So what we're seeing here on the screen is that the growth of $10,000 invested in the S&P 500 starting in 1980, so effectively at the end of 79, through the first quarter of this year. If you were invested in the market in all of those days, so for the full 45 years and a quarter, your 10,000 is over 1.6 million. If you missed just the 5 best days over that 45-year span, you've lost $600,000 of growth, because not only are you missing those good days, you're then missing the compounding on top of those good days. So it drops to $1 million. If you miss the 10 best days, you're down over 50% from what you would have been if you stayed invested the whole time, 730,000. If you miss the best 30 days, so 1 month out of the last 45 years and a quarter, you've made $262,000. The best 50 days, you're probably losing to inflation at that point. So a perfect example of this, and again, we're going to see more of this. We're going to get a lot of news flooding the scene of this trade negotiation went this way or that way. This retaliation happened. This bit of good news happened. When Trump announced the 90-day pause on the higher reciprocal tariffs and dropped it down to 10% for the 90 days to allow negotiations to occur, we saw one of the best days in market history. The S&P 500 was up 9.5% that day. Then the Dow was up about 8% that day. The NASDAQ was up over 12% in one day. So we can imagine, when we show you that the S&P 500 is down 8% on the year, well, if you'd gotten out before that day occurred, you're down 18% on the year just by missing the best day so far. So that's why we are constantly trying to educate clients, and we're all, very, very pleased with how you've handled this recent bout of volatility as investors, because you've all remained invested. So that great day we just spoke about, you all reap the benefit of that day. So we want to continue to remain invested, keep a long-term focus, because if we're out at the wrong time and we miss those best days, it can be catastrophic. Okay, we've shown this chart a lot of times. Going back over the last 45 years, the market's been positive in 34 out of those 45 years. So that's about a 75% clip. So 3 out of every 4 years, approximately, the market is positive. But we see volatility nearly every single year. So these red dots here are the biggest intra-year declines that we've seen in any given year. And we've experienced, on average, a 14% drop per year in these 45 years. Obviously, that's skewed a little bit by the really bad years. But I mean, I think COVID is the perfect example of this. We were down 34% in 1 month. We finished that year up by 16%. In 2023, we were down 10% at one point. We finished up 24%. No one remembers this. We lost 8% in a week last August. No one remembers that because we finished up 23%. So, in year to date, this says a 10% drop and we're down 5%. This is as of the end of the first quarter. So that's closer to 19% and 8% today. But we see this nearly every single year, and we want to remain calm. We want to remain invested. Okay, so I don't think it's any secret we had two really, really bad days in the initial 2 days following the announcement of the tariff rollout. Believe it or not, those two really bad days did not make the top 15 largest single day declines in the market, going back to 1960. So we can see in 2011, we lost 6.66%. 1987, Black Monday, we lost over 20% in one day. COVID, we had some crazy swings. We lost 12%, 9.5%. So what happens after we experience really bad days like that? Well, if we look at this column here, 1 year later, on average, 2008 is the only example where we were not positive a year later, but on average, we're up 30% a year later. Over 3 years, we've averaged 13% annually. 5 years, 12.5, 10 years, over 11% annually. So again, the benefit of staying invested during these extreme bouts of volatility is you're almost always rewarded for your patience. And we've historically seen really good returns coming out of those types of days. Okay, consumer confidence and the stock market. So when consumer confidence is at its lower levels versus when everybody's feeling really good about where things stand, and you can see where we're at today, historically, we're pretty low. And this is as of the end of March. I'm assuming this has actually gone down further in April because that's where the bulk of the volatility has occurred. If we look at the 9 troughs, so the 9 periods where we hit our bottom in sentiment, a year later, the market was up 24%. At the sentiment peaks, a year later, we're up about 4%. So that always leads us back to Warren Buffett's famous quote, "Be fearful when others are greedy, be greedy when others are fearful." Well, right now, others are fearful. If history rhymes like it historically has in the past, we're likely to see pretty good returns moving forward once all of this shakes out. So it's pretty interesting to see that when people are feeling really good about things, the market doesn't do as well because they're normally feeling good because the market just did so well. And when they feel really bad, it's because the market has done bad. And moving forward, you see good returns. Okay, so our last slide, all of this brings us to, as the director of financial planning for the firm, I have to get this in there. It brings us to the importance of financial planning. So if you haven't done a plan, we suggest that you consider doing a plan. Most of our clients have done planning, and it's always good to revisit and update your plan. But the first bullet point is in our planning, we use something called the Monte Carlo simulation. So it takes your portfolio, it runs 1,000 randomly generated market return and volatility trials based off of your plan. And it gives us a probability of success that you meet your goals and don't outlive your money. Well, in this Monte Carlo simulation, there's 1,000 different randomly generated trials Some of those are really, really bad 2008 type of trials. So when we're doing financial planning, we're stress testing the portfolio. We're planning for events like we saw in 2022 when the market was down 25% at one point. We're planning for events like this year when the market's down 19% at its worst point. So financial planning can give you the confidence that we're accounting for periods of time like this, and the portfolio can withstand it, particularly a nice diversified portfolio. Really important for our clients that are nearing or are in retirement. A really important part of financial planning is distribution planning. So heading into a year, if we know you need to take X amount off the portfolio, what we want to generally try to do is make sure that the income the portfolio generates, plus however much additional cash we need to send you to meet your needs, can cover your needs. So that way, hey, the portfolio is going to generate X amount of income. That leaves us X amount shy of what we're needing to send you for the year. Let's take that X amount out of what's done best. So we're selling high, we put it in something super liquid like a money market fund or an ultra short-term bond fund. So that way you're still generating some interest, but it's remaining very stable. So that way we can withstand these types of withdrawals. And also, and part of financial planning is, for those of you who are business people, when times get tough, you try to tighten the belt a little bit. You try to cut back where you can. So if we see extended and deeper declines in the market, we may need to adjust our withdrawal strategy. That may mean, hey, instead of taking out 20,000 as an example for travel this year, maybe we cut it back to 10, so we're not taking as much off the portfolio, giving it time to recover. And as always, we do find opportunities in volatile markets. So it's not fun to go through as investors, but it does present us with opportunities. The first opportunity is pretty simple: rebalancing, just a simple portfolio rebalance. We generally rebalance our portfolios at the beginning of the year, around the middle of the year. Well, what did that mean? Coming off of a really strong 2024, that meant we sold high. We sold what did best, and that was stocks up 25%. And we bought what didn't do as well, which was bonds, which were still up, but certainly not to the degree stocks were. So we sold high, bought low. Now, if markets are still volatile and down when we do our mid-year rebalance, it'll be the opposite. That means we're going to probably sell bonds and maybe some international stocks if they're still positive, and buy US stocks. So we're buying low so that when the market recovers, we see outsized returns there. Tax loss harvesting, we have been doing this over the last few weeks, so we're kind of behind the scenes, always keep staying on top of this. If you have a taxable account, we will sell positions that are at a loss intentionally, immediately reinvest them in a very similar asset so that when the market recovers, so too does your portfolio. But we book those losses to offset capital gains. And then last, if part of your financial plan calls for Roth conversions, we have the market on a discount. So we can do a Roth conversion now versus normally waiting till the end of the year. So that way, when the market recovers, all that recovery is happening in the tax-free Roth account versus in your taxable or in your IRA where you pull money out and pay tax on it. So those are the strategies that we actually have some opportunities to act upon during volatile markets. And always, financial planning is the core of how we want to build a portfolio, because we're planning for times of volatility like this. So with that, we will turn it over to see if there's any questions. Let us pull up our Q&A box. It looks like we have a couple. Okay, so the first question is, will tariffs increase inflation in the USA? Will tariffs cause the Fed to leave interest rates higher? So that's a very good question. And I'll let Evan handle that, and then I'll jump in with any additional comments.
So it is a good question, because it depends a lot on what we actually end up with. Because as Drew had mentioned as he was going through his tariff explanation overview, was tariffs themselves could directly lead to higher costs. There's no doubt about that on those particular goods and services. So that could absolutely lead to potential higher inflation. But he also mentioned energy, right? So for example, if we saw month over month inflation numbers drop in March, and that's because the cost of oil and energy went down. Okay, so there's more than just tariffs when it comes to inflation. So I think that's going to play a huge role in it. Directly on that certain good, sure, it could cause an increase in price. But if it's cheaper to then ship that across the US or whatever it might be, maybe the cost doesn't go up because they saved on transportation costs. So there's more pieces to the puzzle when it comes to inflation. When it comes to the Fed and leaving interest rates higher. I believe right now the estimate is that they would cut twice this year, most likely later in the year. And so the Fed is, to their credit, been very very tight in terms of when they cut and how they cut. The we're more worried about the budget deficit, debt. We have $6 trillion of treasuries maturing this year that are going to need to be refinanced, probably at higher rates. So I think rates will remain kind of where they're at and higher. Will the Fed cut? It really depends upon inflation numbers, the health of the economy, because if the economy is slowing down, that may entice them to cut sooner rather than later. But as of right now, the expectation is twice.
Yeah, I think that sums it up well. And I would maybe just add as well, from tariffs increasing the cost of goods. I mentioned it when I was speaking about them, is supply and demand still plays a very important role in what kind of costs can be passed on. Um, if a company could sell something for 20% higher right now and it wouldn't soften demand and consumers would just buy it, well, they'd be charging that higher 20% now, right? So that they could improve their profit margins. So there's some goods that will go up, like, a BMW, right? That's a German company. If that goes up by 5,000, well, that's, the target market for that's a different subset of folks compared to the average everyday American. So they might be able to get away with raising those costs. Whereas if we're talking about kind of those consumer staples that Evan spoke to earlier, they can only raise those so much before people are just going to stop buying it or shift to something else.
Awesome. I think the other question on here was probably when I was speaking, talking about year to date versus quarter to date returns that were on the stocks and the bond slides I was going through. When I was going over the indexes, that is that is through the end of the quarter was the quarter to date or excuse me, year to date numbers. Okay. The quarter to date column would have been from April, right? The first 2 weeks of April, which has seen the biggest drop. So hopefully that cleared that piece up.
Okay, we just had one other question come in. So far, we've covered a rational approach of the tariff war and what happens if it escalates beyond a tariff war and into a real war, potentially in Europe, Taiwan, or the Middle East. I'm going to cop out a little bit and say we're not foreign policy experts, so we don't know exactly if that's a realistic possibility and how things unfold. I think it's pretty reasonable to expect that if war does break out in various areas, that will lead to volatility in the markets. And then a whole slew of additional problems come down the pipeline. But I can't really speak to how likely that is or exactly how that unfolds if it were something that were to occur.
Yeah, I think the geopolitical conflicts like that, actual war and those types of issues, as Drew said, we're not experts on that. Our job from a market standpoint and from a volatility perspective, absolutely would cause volatility. Historically, if we have a slide that's not in this deck, but it goes through every event and crisis throughout the last 50 years, and wars being a part of it, it absolutely causes short-term volatility. But as always, the market tends to adjust, figure it out, and go up over time. So that, again, a little bit of a cop-out answer right there, mainly because we're not experts in terms of how the actual war part of this might play out, but we know from a market perspective how that would play out, and there'd be some volatility. But our response would be the same as always. The way you are invested is based on your tolerance for risk and how it's going to help you accomplish your goals and how it correlates and as it implemented as part of your plan. And if your plan is, say, I'm a moderate investor, you're going to have 55 to 60% in stocks, and we're always going to keep you in that.
Right. Okay, so we don't have any other questions as of right now. We will maybe give it another 30 seconds or so to see if any additional questions come in. This webinar is going to be recorded like we normally do, and we'll be sending this out within the next, I'd say week or two, probably once the recording is complete. And so please do feel free to revisit. If you care to go back to anything, feel free to share it with anyone that you think may get value out of it. And as always, do not hesitate to reach out to us directly if there is anything else that we can help with. So it looks like that is it in terms of questions. So thank you so much for joining us this morning. We know how valuable your time is, so we appreciate that you were able to spend this last hour or so with us. So thank you very much. Have a great rest of the day, and we will talk to you soon.